Welcome to Investing Now, a channel where you can find fundamental analysis on companies. And my proposal for today is to talk about Dollar General, a diversified retail company that operates in the United States. I've asked ChatGPT about Dollar General, and the information is that Dollar General is a retail company that operates thousands of stores across the United States, offering a wide range of products at affordable prices. Primary focus is on providing customers with everyday household essentials, such as groceries, cleaning supplies, health and beauty products, pet supplies, seasonal items. The stores are typically smaller than traditional supermarkets and are located in rural and suburban areas, making them easily accessible to a broader customer base. And the business model emphasizes low prices, convenience, simplicity, appealing to customers looking for a cost-effective shopping options. As usual, I like to start with an overview on the company, followed by key figures on income statement, balance sheet, cash flow, the estimation of the intrinsic value, and finally the key points about the company. Why to address Dollar General now? Well, after the last quarter results, the company went down by 20%. In fact, over the last year, the company is down by 32%. Basically, it was announced that the operating profit, the earnings per share have decreased. Also, the guidance for the net sales also decreased from the previous estimations of 5.5 to 6% to 3.5 to 5%. And after these initial insights on the company, let's look now at the numbers and try to figure if this valuation makes sense or not. First of all, the market cap of Dollar General is around 35 billion US dollars, a large cap company. The number of employees is 170,000 employees. The beta value is 0.28. Much lower than the average of the industry, which is 1.5. In terms of ratios, price to sales, currently the company has a price to sales ratio of 1, lower than the average of the industry. Price earnings ratio of 15, lower also than the average of the industry, and the price earnings growth ratio of 1.77, also lower than the industry. Looking now at the income statement, we can see that the revenue has increased steadily from 2017. Last quarter shows an increase of 6.8% when compared to the same period of last year. In terms of net margin, the value is 6.8, higher than the average of the industry, also 6.2 in the current period. In terms of revenue per employee is lower than the industry, but the net income per employee is higher. And the revenue growth over the last 6 years was 8.6% on average. In terms of balance sheet, we can see that total debt has increased over the years. In fact, the ratio debt to equity is 2.8, which is considerably higher when compared to the average of the industry. The market value, the market cap to book value is 6, lower than the average of the industry. Of course, this is a high value also, but in line to what I have here in my portfolio. Looking at the cash flow and starting with the net operating cash flow, we can see that the last results are lower when compared to the previous years. In fact, last quarter, the net operating cash flow is lower when compared to the same period of the last year. Also, the issuance of debt increased over the last period, meaning that the free cash flow to equity is higher when compared to the free cash flow and free cash flow to firm. This is different now when compared to the previous years. The cash flow margin and net operating cash flow to sales are both aligned with the average of the industry. and the cash flow coverage is lower than the average of industry, probably due to the higher debt level that Dollar General has when compared to its peers within the same industry. At the capital expenditure evolution, we can see that the value has increased over the years. The last quarter also registered a higher value when compared to the same period of the last year, but the capex to revenue is lower when compared to the average of the industry. On the other hand, the return on capital employed is, when compared to the average cost of capital, is higher than the peers within the same industry. In fact, it's more or less 4 times, and the peers have value around between 1 and 2. In terms of dividends, values have increased over the years. Payout ratio is around 20%, lower than the average of the industry, and the dividend yield, current dividend yield, is 1.4%. Finally, some ratios, starting with valuation ratios. Price to EBITDA is currently around 9, lower than the average of the industry. Price to free cash flow to equity around 14, lower than the average of industry. Well, meaning that these values shows that the company could be undervalued when compared to its peers. In terms of profitability, all the 3 indicators, return on assets, return on invested capital, and return on capital employed, are higher when compared to the industry. Here, the return on invested capital is aligned with the average of the industry, but the other values are higher. In terms of liquidity, I would say that the values are in line with the market and the average of the industry, exception here for cash ratio, which is considerably lower, and the debt to net operating cash flow is higher, especially in the current period, because of increased debt and also decreased net operating cash flow. Comparison between Dollar General and Dollar Tree, which is a competitor of Dollar General, we can see that in terms of valuation, Dollar General has lower values than Dollar Tree. In terms of profitability, the values are higher than Dollar Tree, which is better, and liquidity, the values are more or less in line with the values of Dollar Tree, meaning that the Dollar General has a lower valuation when compared to Dollar Tree, but has higher profitability when compared to Dollar Tree. And let's now estimate the intrinsic value of Dollar General. And for this purpose, I've selected the scenario stable minus, meaning that the projected values are going to be on the lower side, and we will see the values that I've inserted here in this simulation. So first of all, cost of equity is 5.9%, with CAPM estimated 5.5% of cost of equity. Cost of debt is 1.5%, which means that the average cost of capital is 4%. I've estimated a final P ratio of 6.5 when compared to the current value of 15.2. The same for final price to sales ratio 1.1, price to free cash flow of 30, and price to free cash flow to equity of 9.1%, with these weighting factors that are going to be used in the estimation of the prices. These are the projections for the next 10 years on revenue, EBITDA, net income, free cash flow to equity, and earnings per share. On average, the revenue is going to grow at 3.8%. These are the results for the intrinsic value. So currently the price is $167, and the fair value should be around 220 and 240, with lower estimations going to the free cash flow, because past values are also lower when compared, for instance, with the free cash flow to equity. And with the present value of the free cash flow, the minimum value is estimated to be around 180. The cost of equity is 6%, which means that if we would invest today on Dollar General, the annual return could be between 1.5 to 8%, which complies with the required cost of equity, at least when the return is higher than 6%. Looking at the price evolution over the last 5 years, currently the price of 167 is considerably lower when compared to the weighted average of the last 3 years, the weighted average of the last year, and the weighted average of the last 200 days. In fact, over the last 5 years, the price never went down than the value of the weighted average of the last 3 years. The key points on the company. Starting with the guidance, the net sales are expected to grow between 3.5 to 5%. Same-store sales are also expected to grow between 1 to 2%. Dollar General is going to decrease the capital expenditure, and they are also going to cancel the share repurchases in 2023. In terms of valuation, according to my estimations, the company is probably undervalued. It has lower valuation ratios when compared, for instance, with Dollar Tree, but the profitability is higher when compared to other companies within the same industry. In general terms, what are the growing vectors for Dollar General? Same-store sales, more locations, and other businesses such as Pop Shelf, DGX, Fresh. In 2023, Dollar General is expecting to open more than 1,000 new stores, and Dollar General is known for having everyday low prices on quality merchandise, convenient locations, and a time savings shopping experience, of course, because they put effort in operations and to increase efficiency in operations. And this was my analysis on Dollar General. I hope that you have enjoyed. If you have any questions, please feel free to share it in the comment section below. And in the meanwhile, I'll be working in the next company. Thank you very much.